podcasting from a remote location somewhere deep in the heart of New York City. This is Crypto Characters, and I'm your host, Jason Nagy. Our guest for today is the amazing Lewis Stone, Managing Director and Global Head of Business Development for Symbiont. Symbiont is currently deploying production applications for fixed income, currencies, private equity, mortgage-backed securities, and index data distribution. I'm not sure what the last thing is, but it sounds really smart, so Lewis is going to tell us all about it. Lewis Stone, welcome to the podcast.
Well, thank you very much, Jason, for having me here today. It's really an honor to be on your show.
Well, thank you. I'll give you $20 for saying that at the end, okay?
Excellent.
All right, so tell us how you got here. I want to learn a little bit about the man.
Sure. Well, I've been interested in financial markets my entire life. I studied economics in college, and even before that, I did my high school term paper on the savings and loan crisis.
You did?
I did.
What was your what did you say?
Well, essentially,
you don't have a thesis in high school papers.
It was a while ago, but I did actually have a little bit of a thesis. So I thought the savings and loan crisis was I guess triggered by a combination of deregulation on one side, without a proper adjustment on the other side. So essentially, what they did was make it possible for savings and loans, which were a special type of financial institution, which was really there to take deposits and give out mortgage loans, and it was a very traditional business. But in the 80s, sometime after Reagan was elected, there was sort of a trend towards deregulation, and with that deregulation, we saw essentially a freeing up of what savings and loans can do from their small, taking deposits and giving mortgage loans to a much more expansive ability to invest in a wide variety of riskier projects. And as a result, these savings and loans got in sort of over their skis in high risk investments, and ultimately had to be bailed out by the government. And actually, in doing so,
I don't mean to interrupt you, but I feel like that might have happened since then, once or twice, also.
Yes, well, it's actually not too different in many ways from what we saw with the financial crisis with TARP, but. Essentially, I think Alan Greenspan was the Fed chairman at the time, and I think he was the one who I believe came up with the securitization process from there, essentially creating institutions to buy up all of these mortgage loans, and that was sort of the very early foundations of the mortgage-backed security market.
Well, that worked out great, didn't it?
It you know what? It's funny because the mortgage-backed security market originally, in its original form, was actually extremely safe and secure. It was essentially what they call conforming loans. So all these loans were met very sort of specific criteria, and there's 20% down, for example. Just as an example, they fell within certain ranges and prices, and you knew that if there was a default, there was a mechanism for dealing with that default.
In the SNL crisis, pre-crisis.
No, this is post SNL crisis, but pre-financial crisis.
Okay.
And it was actually like another round of deregulation that took place that essentially allowed the variety of assets that can go into mortgage-backed securities, allowed it to expand dramatically. So going from only what they called agency securities, which were securities that the principal was either implicitly or explicitly backed by the federal government. So this is sort of the Fannie and Freddie, to essentially being able to throw in all sorts of different types of private loans into these structures that could then be used to issue securities. And that, along with sort of applicable ratings agencies, created essentially a large issuance of securities that ultimately led to the financial crisis. Obviously it was a very complicated, very complicated set of circumstances that led to that crisis. But ultimately, it came down, in my view, to the idea that that the underlying loans that were being made were not high quality, or were not of enough quality to make creditworthy, even if you did these sort of financial engineering credit pooling techniques that had been successful in the past at being able to take somewhat risky assets and be able to create much I guess less risky profile in the assets that are built off of it.
So that's interesting, because what I didn't realize was that, what's the best way to put this? The 2008 crisis was actually a crisis because the underlying mechanisms that were created to prevent the S&L crisis were taken out of context or used in a way that they weren't intended. In other words, non-Fannie and Freddie loans. Is that essentially?
Yeah, I think that's
part of it.
I think that's a big part of it. So one is that structures became popular that were non-Fannie and Freddie loans. They were getting the ratings that they needed for institutional investors to invest in them. But at the end of the day, you had these assets that were highly rated, but they were all sort of backed by the same junk, for lack of a better term. And because the markets, the way they had developed, were so complex and opaque, when there was a problem, it was amplified. Essentially, it created more than a problem that was financial. There's sort of a crisis of confidence when you had no understanding of who was in control of what, who institutions were sort of disappearing that you expected to be there forever, and you just, for the first time, investors in very highly rated securities didn't know if they were going to get paid back, and that caused a tremendous amount of disruption in the financial markets, obviously. And it took extraordinary action by the federal government to right the ship. And you could debate whether or not it was exactly the correct action, but I think most folks that are close to financial markets recognize that we could have experienced a much more severe economic turndown in the real economy had we just let things unravel without any intervention.
You think?
I do. I think so. My personal view is that we were, as a country, too light on the institutions that caused the problems, and the appropriate thing to do, whether it's the best for the economy or not, would be to wipe out all equity holders in these institutions and recapitalize the banks as new institutions. Because as far as I was concerned, the big banks out there had failed, and the equity holders were bailed out, which is not what's supposed to happen in capital markets.
I mean, at the time, I thought it was a good idea to stop the banks from going bust because you also had deposit holders. If they had over $100,000, they could lose their money. So it was the underlying deposits that were more my concern than the stockholders. But I've been reading a lot of Thomas Sowell and Milton Friedman, who I think, if Milton Friedman was alive, he died 2 years before the 2008 crisis, he would have said that you need to let the banks die. But for the FDIC issue, I think that really, it's probably would have been the better solution because they were sick.
Well, again, they were sick and needed to be recapitalized, and
right.
The equity holders in those institutions, needed to be punished and wiped out. Investors in those entities shouldn't have been rewarded for those investments because the company's lost. At the same time, all of these institutions played very critical roles in the real economy, and having basically, every branch or 70% of the branches of banks in the country go down was going to have ramifications that were even more severe than we experienced. At the end of the day, very few people lost their deposits, and there were few, although there was a handful of bank runs, and there was the closest thing to bank runs that we saw were actually in capital markets, where hedge funds and other asset managers were sort of rapidly fleeing from their prime brokers.
Right. That's true. There was so many levels of mess to the 2008 crisis. It's every podcast that seems to come up. What were you doing in 2008 when the crisis hit?
So it's funny you ask. I was working. So I had graduated business school in 2004, and I wanted to start a hedge fund. I was sort of
too bad for you, right?
Exactly. That was actually something that was I'm very lucky about in retrospect, because the strategy that I was pitching ended up performing extremely poorly through that period, as did pretty much every hedge fund strategy. But in any case, after trying to raise money for this hedge fund for several months after graduating, I realized that I needed to find a job, and
right.
and just semi-randomly, I wasn't raising money fast enough, and I wasn't independently wealthy.
You had no experience. Why wouldn't you have been able to raise money to run a hedge fund, right?
Well, it's funny. I
just graduated.
I did have no
college,
experience. Right? I did just graduate. Well, this was business school at the time, so
okay. Sorry.
I
wasn't trying to imply that you know what you were doing.
No, so it is fair to say that I didn't know what I was doing, but I would.
I wasn't even saying that. So okay.
But I did have a good 7 or 8 years of sort of direct capital markets experience prior to that, and I had gone back to school to study essentially all of the academic research that was out there that what they call in the research return anomalies, or essentially sources of return that are not explained by the market. And me and a classmate of mine sort of decided to come up with a strategy that would sort of aggregate and exploit these return anomalies. The strategy.
Tell me what that is.
So
a return anomaly first. Let's go over that.
Yeah. And
then I want to hear what your strategy was.
Sure. So basically, a return anomaly is I guess a concept that's based on the efficient market hypothesis, which is saying that all of the returns in the stock market, in this case, can be explained by beta, or the overall performance of the stock market. Any other returns are essentially like spurious volatility and luck, and
there is no true alpha, right?
That was sort of the general premise, and
well, let's just say what alpha is, because I only know that from the time that I tried to dabble, and not really dabble, but understand hedge funds. So why don't you just explain what alpha is?
Sure.
You'll do it better than me.
Sure. So alpha is the part of returns that are not explained by the overall market and are attributed to skill.
Based upon how awesome you are as an investor, right?
Exactly. So that skill can manifest itself in a few ways. One, it could just be someone who's really good at picking and timing markets. That's one type of alpha. But another type of alpha, which is at the time was alpha, but now has sort of a new name, which they call it smart beta, which are essentially.
It's great.
It is funny how they do it. But basically it's systematic strategies. So a something that you could just do over and over again without any thought. Systematic strategies that produce returns consistently over time that are not explained by the overall market. And there's a number of these that were identified in the academic literature that were the source of many hedge fund strategies of the late 90s and early 2000s. So the most common is the value factor. So essentially, if you were to rank stocks by value, defined as price to earnings or price to book or some other more sophisticated version of value, over long periods of time, and this is going to sound very obvious and intuitive, but stocks that have a low price to book or a high value tend to do better over long periods of time.
You mean like Berkshire Hathaway tends to do better? What is it? How much is a share of Berkshire Hathaway now?
I don't know.
It's never
very
halved,
expensive.
Right?
Yes, they never split or anything. So that's basically how much it naturally rose over time.
What is it like? It was like 50,000 or 100,000.
I think it's over 100,000 now. I haven't looked at it. I couldn't afford the 100 lot to get it off of my broker. just kidding. I couldn't afford a 10 lot. But essentially. Where did I talk? So there's a number. So
you were talking about value factors.
So value is one of the return anomalies. So if you were just to invest in high value stocks, and were to adjust or go short everything else, over time the value stocks would outperform. Another one is size, which is another unintuitive one. That if you were to invest exclusively in small cap stocks and go and hedge that out with the rest of the market, over time that would outperform.
Small caps over time outperform large caps?
Yep.
Is that a theory, or is that actually generally speaking a rule?
So as of 2004, when I was in school, it was absolutely well tested and well documented in the academic literature. Other ones which were also kind of interesting are momentum. So if I forgot what the exact metrics that were used for the studies, but they did it with a bunch of different intervals. But essentially, if a stock did well in the last 90 days, it is more likely to outperform for the next 30 days than the market. It was more likely to outperform the market for the next 30 days.
Interesting.
So there's a handful of these. There's not that many, but there's enough of them where you could develop a strategy around them and essentially give yourself exposure to value, size, and momentum in such a way that you hedge out your market risk and you're able to generate returns in a systematic fashion that are not explained by the overall market. Now, what I described, these systematic strategies that were publicly identified in academic literature in the late 90s and early 2000s, are now what I was describing before as smart beta, which are essentially they're ETFs or indexes, which are essentially baskets of stock that are constructed using a methodology that is, involves no discretion, but basically follows a set of rules, builds a portfolio, based on size. If you look it up, you'll see there's an MSCI value index and MSCI size index and MSCI momentum index, and all of these are essentially tilting your market exposure towards these factors or these non-beta or non-market sources of returns.
And is that so? You're saying that these things are now called smart beta?
Correct. So
which implies that they actually are relevant in.
Yeah,
since 2000.
Yeah, no, they're absolutely relevant, and
Okay.
And these are, I guess, well tested, robust anomalies that were identified, and exceptions to the efficient market hypothesis that have persisted. They go through time, like periods of time, and even in the past, they've gone through periods of time where certain factors would outperform others, but
right.
For the most part, these are general truths in the market that, at least based on sort of the philosophy of my professors, were based on sort of inherent behavioral biases in the way decisions are made and the way.
Wait, what inherent behavioral biases? That sounds really interesting. What do you mean?
So like people, so for example, people will, tend to hold on to losers longer than they should, and tend to take profits quicker than they should. Now,
that is, wow. That's so I'll tell you. I interviewed someone named Alon Sapori, and what he said to me was, I asked him what advice he would give, which is, I think it was something like, learn when to cut when your losers. Like when it's not working, learn to stop it. And that was so. I mean, it's the other side of that same coin, right?
Very true.
Holding on for too long.
Exactly, and that bias and a handful of others are used to explain these anomalies that I described. I went to a school that was sort of focused on the behavioral explanations of these anomalies. If you were to go to like the University of Chicago, where they're very much focused on efficient markets, and they don't believe that these behavioral biases could exist, they would argue that you're taking on a different risk profile when you take take on, for example, the small cap stock is a good example of that. If you're investing in small cap stocks, there's a liquidity premium for that the market attributes to holding these smaller stocks, and that's why you have the outperformance. So
let me interrupt you right there. So liquidity premium means that they're less liquid, so you're going to pay more when you want to get rid of them. It's going to cost more, or
no? It's the opposite. It's basically because it's less liquid, and because you have to deal with that extra risk. Market participants aren't willing to pay as much for a comparable liquid security. So as a result, you should be compensated more for holding in a liquid security, and therefore that is the explanation for why a small cap stock might outperform a large cap stock, at least from the efficient market standpoint. The behavioral, and again, this is just sort of a debate.
So before you go to the next one, I just want to make sure I understand it right. So this is the non-behavioral economics?
The efficient markets.
So the efficient markets theory says that the reason why small caps do better is because
they're riskier.
So they're riskier. So, and how does the premium come into play? That's kind of what I want to understand.
So riskier, the premium just means that it's just another way of saying, and probably not the best terminology, but it's just another way of saying that you get compensated. The risk premium is the amount you get compensated for bearing risk. So it's a higher risk premium for small cap stocks than larger cap stocks. Is just what I was saying.
Oh, so essentially you get paid more because they're riskier.
Exactly.
But you get paid more on your return, or do you get paid more because they sell higher? What's the reason for the higher payment or the higher return?
Basically, they're just saying that, this is sort of backwards, but there's been a lot of research showing that small caps outperform large caps, and when they're coming up with explanations on how to explain that, the behavioralists come up with explanations that are related to your psychology, and the efficient markets people are saying, oh no, there's no room for that. You're getting compensated more because you're taking more risk, and that's sort of the dichotomy.
Gotcha. So behavioral says there's a reason for it from a psychological or behavioral perspective.
Exactly. And
the efficient market's saying no. That's actually just because you're paying more because it's higher risk, or you're getting more because it's higher risk, right?
Exactly.
Okay. It took me months to understand the whole risk premium when my brother, who was kind of like a math and investing guy, explained it to me. It was as someone who comes to the world with like a lawyer bent and not an investment bent, it was inherently an odd concept.
I'll tell you what makes it even more odd, which even me as a finance person, I still forget sometimes, but it's like completely theoretical. No one knows what the real risk premium is. Like the equity risk premium is just sort of like, oh, it should be 4.5%. It's historically been 7%. Like no one.
I made a lot of money. Why? Well, there was a risk premium there. What is it? I couldn't tell you. I just know I made a lot of money.
Exactly.
Okay, so I'm excited because you're an economist in a certain respect, or at least you understand economic theory, right?
A little bit, and again, I've been
a lot more than me. Let's say that.
I've been very. I'm hesitant to call myself an economist, but I have been a very close observer of markets and very interested in economics my entire life. So, like I mentioned, I starting from high school, going through study in college to pursuing a career in capital markets, and my first job actually as a currency trader, I got to sort of really firsthand get a front row seat at sort of the markets that I was interested in my entire life. Even like what made it even crazier was going through college and even might have even been in high school. There's a book out called Market Wizards, which were interviews with all of these top traders, with George Soros and Paul Tudor Jones and those types, sort of the first generation of the hedge fund industry. And I was like very much in awe of them, and that was sort of what I stood up as what was
they were your heroes.
Interesting. They were my heroes.
They were your Hercules.
Exactly. Thank you very much.
My kids just watched that, so it's a Greek mythology. They're asking me about Hades and Hercules. It's very funny.
I need to see that one, but yeah. So
it's not bad for kids. I mean, it's not terribly scary.
That's good. I'm the one who's more likely to get scared in that scenario, but but it's good to know. Good to know. Yeah. So basically, these folks who were sort of the masters of the markets from my perspective, were the customers of these trading desks that I joined. So I went from being in college as I graduated when I was 21. I just turned 21, and a few months later I'm sitting there and I hear they had code names for all the hedge funds, so their names didn't get out. But
who did?
The trading desks. So if a customer,
so you're at your trading desk trading currency, right?
So I was at a trading desk trading currency, and then a big hedge fund manager would call up and want to trade against you, or they want to price in $100 million yen, or they want to enter into some transaction, and our job was to essentially sit there and make them a market. So these are like the smartest guys in the world who have done all this sort of research into why the market is going to move where it is, and they've done all this analysis, and now they're coming to the bank and some 20-something-year-old guy and saying, give me a price. And basically you have to make a two-way market, which means, say the price is 50-55 and they sell to you at 50, and all of a sudden you have this position and you have to trade your way out of it. And when I first entered into the market as a currency trader, the markets were very, I would say, very antiquated in terms of their technology. It was
when was that? What year?
It was 94. So there was
94 to when did it stop becoming antiquated?
So probably 2002-ish is when it really when technology really started to take over.
So for the first 8 years, it was pretty antiquated.
Well, you got to see the transition. So at first, the markets were dominated by these voice brokers who would be shouting out prices, and essentially bids and offers that were being supplied by a constellation of banks. But it was very inefficient. There's like different people with different prices all around, and essentially what it created was a market that had very wide spreads. So let's say spread was 5 pips then for $5 million yen. Now it's about a half a pip. And
what's a pip?
A pip is I guess the unit of the unit of measurement for currencies. It's a fraction of a penny.
It sounds cute, pip.
It is cute. It's a very, very small it's a very, very small increment of currency, but when you're dealing in many millions of dollars, it comes up to be substantial amount of money. And basically when there's voice brokers dominating this market, information was at a premium, to use that word again. And
when you say voice brokers, you just mean dudes yelling at each other, right?
Yes, but it was like over a microphone like this. So
really?
every bank desk had a microphone that piped into these guys there's a few of these brokers out there, and you would say to the broker, you'd push a button, you'd say, I am 35 bid for 5 million, and then they would be shouting it out, and all the other banks would hear it, and then someone would say yours. And
that sounds wild, man.
It was wild, and it was definitely. It's funny because it was an amazing experience, but I knew it was never for me. Like, I was interested in knowing what made the markets move. I didn't want to
shout and yell.
I didn't want to shout and yell, and I didn't want to basically have to take the other side of my heroes. They were
right.
They knew what they were doing, and I basically was just trying to make that spread, which was rapidly disappearing with technology I was seeing. So
essentially, a hedge fund would call you. Did you work for a prime broker or another kind of broker?
So I worked for a currency trading desk. So it was at a bank. I worked for I can say, I think
doesn't matter.
Paribas. Well, anyway, I worked for a French bank. There was a.
You said it, so you.
It doesn't exist
matter,
anymore.
Really. It doesn't. Paribas is gone.
Well, now they're BNP Paribas.
Okay.
So,
okay.
But there, and I don't even know if it's really organized this way anymore. But at the time, there was a desk of salespeople that would speak to the hedge funds, and then when the hedge fund would tell them what they want to do, or they would want to ask for a price, then the salesperson would shout across to us, the bank traders, the members of the interbank market. They would shout, "We need a price in this amount for this customer," and you would give them a price, and then they would deal with you. And then once,
so you would buy it for them.
So you would. It was actually. It wasn't really for them because they were buying it from you, and then you had the position, and then you had to go out and deal with it. So they got the advantage of having an instant price that they can deal on, and I had the advantage of essentially having a small head start to get out of the position that they were in. It's
a weird. It sounds weird when you say it that way, but. It's true. Yeah, it's what you're doing.
That is how it worked then. But I guess, to make a long story short, this was sort of my first introduction into technology and financial technology in particular, and I got to see how a matching system, how an electronic trading system can bring so much transparency and efficiency to markets. So I saw it. Without going into numbers that won't make sense to anybody, spreads decreased by 80 or 90% in that period of time.
In other words, the amount of money that you would make as a trader decreased by 80 to 90% on the trades, right?
Exactly. And again, it wasn't a locked-in amount. It wasn't really a commission, but it was the theoretical amount that you make on a trade is the spread divided by 2.
And that's why the trading system is gone. Right?
Yeah, or at least the trading desks are gone. So
the guys yelling on the floors.
The guys yelling on the floor.
Right,
yeah,
they're gone.
Those guys are gone. And these currency brokers weren't technically on a floor, but it was a very similar type of setup. They were sort of the centralized hub for these institutions, and really technology has made it much more efficient and much better for the other side of the trade, for those who want to transact in the markets. Now they know where the market is at all times. They have access to a lot of liquidity, and very low transaction costs. So
Right.
so watching technology really transformed the way those markets operated, and made them far more efficient, and really shift the balance of power from bank trading desks to the customers of those bank trading desks. So that was sort of led to the next part of my career, where I wanted to move away from the sort of market making role and move to a proprietary trading role. So I ended up taking a job at a bank in Saudi Arabia, which
You lived in Saudi Arabia.
which was a very odd chapter in my life. But
How long were you there for?
I was there for a year, and the idea is that I would get a chance to trade as a purely discretionary trader. I didn't have to make markets for any hedge funds, and I would get to just sort of sit back and try to become sort of a one of those folks that I idolized so much. But
That was take two, right?
that was actually
Or that was take
That was take
one.
one. That was
Okay.
take one. So it turned out that it was, for even then, Saudi Arabia was a difficult place to live, especially for
Can't imagine. Really?
especially for a single guy. And I'm not a religious person, but I'm also I'm of Jewish descent, which added
You were
to
perfect for Saudi Arabia.
So they love me there, but
You're lucky they let you in.
I am. Yes, I am, and well, I'm lucky I got out to be more
Also true.
to be to be more accurate. But in any case, the funny thing about it, when I got out, or when I returned, that's actually how I got my first fintech job, and actually got introduced to my current CEO, Mark Smith. So when I got back, my intention was to go to business school, to apply to business school, but I had a few months to kill. So I applied for a brokerage account at a newly launched FX brokerage called Matchbook. And when I filled out my application, they called me up and they said, "Well, we don't really have a trading platform yet, but we're building one, and we're really looking for folks with your background to help us build out this marketplace. And would you be willing to come do that?" And I had a few months to kill, and I thought, sure, why not?
Was it a perfect fit?
It was a perfect fit. It matched my background, and finally I got to see this technology that had really decimated this my I guess my past role, which is a market maker at a bank, a currency market maker at a bank, which I don't. It barely exists anymore. That role.
Yeah, that doesn't exist.
Yes.
By the way, when you said make a market for someone, I didn't want to interrupt you, but I do want to have it in case it's not clear. So why don't you kind of explain what that means in trading parlance? Make a market for someone.
Sure. So when you're about to deal with the counterparty, they don't necessarily want to tell you whether they want to buy or sell. So as a market maker, it's your responsibility to make what they call a two-way price, or provide a bid and an offer to that counterparty. So sort of in an effort to provide a fair, neutral price, you can say you could give a bid and an offer, and then the counterparty can choose to buy or sell it. They sell at the bid or they buy at the offer.
Got you. So you say I'm a buyer at this price, and I'm a seller at this price. Is that how you? Is that what you say, or do you?
You usually just say the two numbers, and they know that you're selling at the higher number and buying at the lower number. if
Right.
if you do it the other way, like it's funny that it's very rare that it would come up, but every now and then, like a very macho trader might show off by providing an inverted price, which has a higher bid than offer, which is basically just taunting the counterparty to deal with you. More often, it would be a choice price where it's a price where they don't give any spread at all. Where they say 35 choice, you can buy or sell at that price, and that was basically a way of the trader saying that they were not scared of you at all, and you could you could do whatever you want.
So funny that we have all these different ways to like pump our chests at each other.
It is funny, especially in trading. It's a very I would say a lot of chest pumping in that world.
Well,
probably less now than it used to be, but
because machines don't have chests.
Machines don't have chests, and programmers don't have chests, and quants don't have chests, which are really the folks that are dominating markets these days. When I was growing up, the markets were really dominated by people shouting on the floors. I watched Trading Places growing up. It was my favorite movie.
Oh, that was so good. the bearer bonds, right? That was the one with they were trying to steal bear. I know there was pork bellies involved, but
I think the bearer bonds was a different one. I think that might have been I forgot which movie that was. But it's a different movie, but it was frozen orange juice and pork bellies and Trading Places.
That's right. Pork bellies.
Pork bellies. Exactly.
That was such a great movie.
Yeah.
All right, so you were a currency trader, so I suspect you know a little bit about currency.
I do, and it's funny. Currency trading wasn't initially what I thought I was gonna get into, but it turned out to be very much related to what I had studied in economics, and one of my interests as an economics student was really what's the nature of money, what gives money its value, and that's sort of the type of thing I had to think about every day.
So tell us, what is it?
So it's a combination of things. So one, it's there's a supply component to it. So there's an amount of money out there and an amount of goods and services out there that this money can potentially buy and chase.
That's like a classic economic theory, right?
Yeah.
That part is, at least.
Yes. So, and again, I think it's all, in the long term, it's all economic theory. It's those types of factors are what's going to determine the long-term value of a currency. It's really the amount of that currency and the amount of goods and services produced produced and denominated in that currency.
Okay.
And that's sort of the theoretical driver. However, in the short term, it's really flows that determine the price movements. So
what do you mean?
So
flows.
So for example, if there is a need for an American company to buy a British company, they would convert a bunch of dollars into pounds,
right.
and that would drive up the pound a little bit. Or there would.
I never thought about that, but I guess that's true, right?
Yeah, and it's actually, that particular transaction really has no impact on what the long-term level of the currency should be. But in a day or in 2 days, when those dollars are being converted into pounds, it has a real and definite impact on the prices. So,
would you trade those bumps?
Oh, absolutely. That was sort of what I was trying to do. So, I mentioned earlier that a lot of what I did as a trader was try to understand how information is discounted into the market. And
right.
One of the things that I would do as a trader was I would write down everything our customers did and mark it on my charts, and I would over time get a feeling of based on evidence of which which of our clients tended to know what the market was going to do for the next 48 hours, and
Right.
and which tended not to really have much predictive value. And I would use that to help determine my positioning based on
That's
that.
pretty cool.
So that was, again, these are sort of the little sort of tricks that traders come up with to try to eke out a living. But
Juice their returns.
juice, it's not even juice. It's like you have to get them somewhere, especially with spreads going where they were. So
Right. 80 to 90% reduction. Yeah.
Exactly. So, in that, and actually that, my view on currencies, or my study of currencies, I think had a lot to do with my interest in Bitcoin as well, which is sort of what got me into the blockchain space. But taking a step back, with currencies, I mentioned that it's based on the supply of the currency, and how much goods and services that they can be purchased in that currency, essentially. But
What did you say, with the supply of the currency?
exactly. So
Okay.
So
Tell me what you mean by that.
so really, how much money there is out there. So if there's, and money can be created in a number of different ways, but essentially it's by the central banks and
Right.
through monetary expansion. If there is a lot of money chasing very few goods, then we see what's called inflation, and the value of money is decreasing relative to goods and services, and another currency that is not facing that same oversupply situation. So
I want to ask you this, because
Sure.
as a lawyer who doesn't
Mhm.
really didn't really understand a damn thing about business until I was advising clients on it for about a decade. And as someone who's recently appreciated what economics was, I mean, I had to take an economics class in high school, and I literally wanted to pull my eyes out. I mean, I didn't have the greatest teacher, right? But it was so far away from anything that interested me, or that I just knew that you could use money. But I want to understand. I know that the government can print money. It can always print money. And it does. That's how they do that. That's the whole monetary easing strategy that maybe saved us, or maybe extended the economic crisis, depending on who you know. And I don't know what the answer is to that, because I just haven't really looked into it. But because a government can always create more money, or at least the bigger governments do. How do you know how much money is in circulation, so that you're valuing that? Is it based upon goods and pricing, or do the governments have to release the amount of dollars in there? I mean, how do you figure that out, and why don't you always assume that there's an unlimited amount of money, since that can be the case?
Sure. Well,
These are novice questions, I get it, but maybe you can explain that, because I think that would help go towards understanding Bitcoin valuation too, maybe.
Sure. So the supply of money, at least the modern in modern economies, is something that is completely controlled by central banks, and central banks are established with a goal. And in the case of the U.S., they have a dual goal: essentially price stability, and sustained economic growth. Sometimes those things are in conflict with one another, but basically the general idea is when there's too much money out there, there's too much money chasing too few goods, prices rise, and we see prices go up. And at that time,
I knew that part.
But at that time, the central banks then have tools at their disposal to reduce the money supply.
So let me stop you right there.
Sure.
I love my dad. I'm not making fun of him.
Okay.
Okay. But when he grew up, it was 5 cents to see a movie. and maybe like a hot dog was a penny or some ridiculous thing like that. He grew up in the 40s and 50s. So now, I don't know what a hot dog is. It's $5 or more, right? So it's not 10x because that'd be 50 cents. It's, I don't know how many X's that is, but that's inflation.
Correct.
And it's never stopped. I mean, from 1942 or 1945 until now, right? The price of goods have always increased steadily, right?
Yeah, and I think the idea behind that, or that is true, and I think the reason why that's allowed to happen is that there's a notion that there's a trade-off between price stability or inflation and economic growth. And the idea is
you're smart, man. I love this. Okay, keep going. So the idea is
that people are willing to put up with a small amount of inflation. That again, it's severe, but it happens over long periods of time. If it means that there will be more rapid economic growth. So, just as an example, if you know that you're going to lose 4% a year if you put your money under your pillow, but if you put it in the bank, you can get
0.001%, right?
Just for this example,
Okay.
We're going to say 5%. So in that case, you're getting a real return of 1%. And now, instead of your money being under the pillow, that money can be lent out to drive economic activity. And I think if you were in the opposite scenario where there's where prices are actually going down over time or deflationary, it will actually bring disincentives to economic activity. You're more likely to put off a purchase.
Because prices are going down.
Prices are exactly. So you're
right. You're gonna. Hey, I'm gonna wait for a couple of months.
I'm gonna wait for a couple of months. I'm going to. Why put my money in the bank? I'll just stick it here. But essentially, inflation is almost like an economic lubricant that keeps the money flowing. But I will say,
I never thought of that. But it's a damn good point, isn't it?
Well, thank you. But it hasn't been that way forever.
It's not your point, I know.
And by the way, it's I'm going to give you a scary point now. Is that hasn't been the case forever. For early in my lifetime, I don't remember this, but we used to be on a gold standard, and it used to be the case.
You were alive when the gold standard was there, man.
I believe I was just a baby or so.
All the millennials are freaking out. Me too, by the way.
He's like, you're alive? But
wow, man.
I almost can't believe it myself. But essentially,
why you have the gray in your beard.
Exactly. So yeah,
Nixon took us off the gold standard, right?
Took us off the gold standard, and essentially, what gold did as a standard, even it constrained the growth in money supply. Basically said it could only increase by the amount.
Gold did.
In
the amount of gold reserves that you had.
Exactly. And that, even though that's not the case anymore, gold is still there and is still growing by approximately the same amount that it has been over eternity. It's something like 3% a year, which is also coincidentally approximately what most economists say is the long-term growth potential of the economy. So what you have
3-4% a year.
Exactly.
So is it the economy's tracking gold, or is it just coincidence, or what?
So you'll get. I think it's just a coincidence, and
right.
I think most economists who got us off the gold standard agreed that it was a coincidence, and didn't think that we should be constraining economic activity based on sort of the characteristics of gold or a natural commodity. That's so I think That said, even though gold isn't the real underlying backer, it's still there as a reference. So everybody can look at the price of gold as sort of an indicator to how
our economy is doing, or our
how
GDP, our growth.
I would say even more so how responsible our central banks are being. So if central banks are printing ridiculous amounts of money and you would see gold prices spike up. If they're not printing enough, right. You might see it spike down.
I'm waiting for gold to drop because I'm going to buy it at a dip. So can you tell me when that's happening?
Well, I think that's a good segue to the next piece, because I think we're in a secular downtrend in gold, because gold used to be unique in its status as this monetary financial asset that has no other obligations associated with it. So essentially, when you own a bond, that's somebody else's liability. When you own a dollar, that's the government's liability. When you own gold, it's nobody's liability.
It's just your money.
It's just your money. And because of it has other characteristics which have been attractive over long periods of time. It's durable, it's divisible, it's easy to identify, and so forth. However, all of the really positive characteristics of gold and more can be found in Bitcoin. So that was sort of what got
Sounds
me.
like that drop gold ad that I saw coming out the other day.
I didn't see that ad. Is that the Circle one?
I think so. I forget who it is, but there's like this, drop your gold campaign trying to push Bitcoin.
Yeah. So I think that is I think Bitcoin is similar to gold, is an excellent reference asset in that we know what the total supply is, and we know the rate at which that supply will grow, and we also know that it is that it can't be counterfeited, that it's divisible, it's as durable as the computer networks out there that support it are. So from a financial standpoint, Bitcoin has many of the same characteristics as gold, except in many ways it's better. It's much easier to transfer. It's easier to store. So all of the folks out there that look at gold as a hedge against, I guess, unethical or that's probably not the right word, but of just bad behavior by the central banks of the world, gold has traditionally been a hedge to that. But I feel like Bitcoin, I don't feel like it. I strongly believe that Bitcoin is going to be even over time become the dominant reference asset that gold is currently serving as.
So what do you say to all those people who are like, this Bitcoin, it's crap. It doesn't really mean anything because it just exists on your computer and you can't do anything with it. I mean, forget about the it's crap part, right? But it's, gold has been around for thousands of years. Mm-hmm. Bitcoin has been around for 10.
True.
So, I mean,
again, I think it's just the time at which it's been around, I think, is less important because it doesn't exist. What's important is its durability and the fact
right.
that it lives on a decentralized network around the world tells me that it's just as durable and resilient as gold. In terms of the
how do you price it though? So I got that part. Believe what you want about Bitcoin. I don't really care, right? That's not the purpose of this. That's like a conversation that people had 3-4 years ago over drinks, right? You'd have that with your your uncles or whoever it was, or your neighbors, or someone that really wasn't paying attention, right? But how do you would value currency? You said based upon the amount of currency that was out there, right?
Yes, and the amount of currency that's out there.
Strength of the economy too, I would imagine, that backed it, right?
Well, I would say.
I don't know. I'm asking.
Yeah. I think the strength of the economy I would put into like a broader category of sentiment, but yeah, I'm just trying to think of. Yeah, so it's really supply and demand. If there's too much money out there chasing too few goods, then the value is going to go down. If there's not enough money,
just that, it's just supply and demand.
Well, so it's supply and demand as the core fundamental driver of value in the long term, and in the short term, it's a variety of more, I guess, transient effects, which are related to sentiment. So, for example, like you mentioned, if people are believing that the economy is strong and will continue to be strong and get stronger, that might be a reason to invest in a currency, or at least in assets denominated in that currency.
Okay.
The issue with currencies, though, why they're a terrible investment in general, is that price stability is the goal of most central banks. So
they don't want it going up or down.
So it's just, it's
a really good point. I never thought about that, but you're right. You're right. You want it even, right? You don't want too much inflation or deflation. Those are bad either way.
Exactly. And again, this was a college paper I did, but basically I tried to argue that as long as the inflation is known and predictable, that a small to moderate amount of inflation is good, because it tends to incentivize people to move money to more productive areas of the economy, whether it's investments seeking higher return, or whether it's consumption of goods and services.
Now, didn't you say earlier, though, that there's another side to that coin that's not always the case, and it hasn't always been that way?
About which part? Sorry.
Inflation. Like having a slow and steady inflation didn't always drive the economy.
Well, I'm trying to think of what
I stumped you. It was my point. It was my purpose.
Yeah, I don't remember exactly what we were referring to, but
okay. And I might have gotten that out of context, which is why I'm asking. I want to make sure that I understand it.
Yeah, well, I just think having well, I think what I was saying before was more related to deflation or unexpected inflation, but essentially unexpected price changes result in sort of random redistributions of wealth that lead to inefficient economic outcomes. So I guess having stable prices creates sort of an environment that is conducive to economic activity, and it makes you. So, for example, if inflation reduces the value of your debt, so if you are expecting a lot of inflation, you might want to take out a big loan and hope to pay it back with less valuable dollars in the future. But I guess.
But that's deep thinking, because most people, I don't really think that way, right? I mean, I certainly don't think that way.
Well, yes, because we've been fortunate enough to have gone through, despite the statistic you quoted earlier from your father. We've
hot
had
dogs for 5 cents.
We've had very relatively benign inflation for pretty much as long as I can remember. When I was a child in the 80s,
70-year period that we're talking about pricing.
Right. We had maybe 10% inflation. I remember that in the 80s. I think.
You actually remember that?
I do. It's very strange. I really was into this stuff, so I remember.
You're not kidding, man.
I remember actually my father was a jeweler, and the jewelry business was sort of in decline in the 80s, and he sort of would fill his time trading gold. So he actually got a setup, and I believe, I don't know if it was true at the end, but at the beginning it was his status as a jeweler allowed him to hold gold. Like when gold was used to back currency, not everybody could hold it. So it was you needed a special reason, and being a jeweler was one of those reasons. But anyway, so I did watch that. I remember when gold almost went to 1,000 the first time, and
that was in like the early 2000s, right?
It was the 80s.
Really?
Yeah, and it went way past 1,000 in the 2000s.
In the mid 2000s, that was like 300 an ounce, right? Or am I just getting everything upside down?
I think you could be right. It went from
at some point not that long ago.
It was
20 years.
Yeah, it went from like 900 down to like the 200s, and then we had a big spike up again.
Should have bought it then.
Yeah, we all should have bought it then. We should have bought Bitcoin, which is
that's right.
And
should we still buy Bitcoin?
I agree. So I think yes, we should, and for the reason that I mentioned before, that I believe there's going to be sort of a substitution effect to use Bitcoin as a generic store of value that's not linked to a government. It'll be more attractive than gold. The current market cap of gold, I think, is about 9 or 10 trillion, which is, right, I think, more than 10 times what Bitcoin is. I think there's no reason why those two numbers can't converge.
Really?
Yeah.
Well, that'd be pretty interesting. So, Bitcoin at 20,000 to me sounded absolutely crazy. It's proved to be true, at least in the short term. You hear people talk about these high Bitcoin valuations, and I think they relate it to gold, and I think they're assuming that 3% increase or something along those lines. But do you know what I'm talking about?
Well, the 3% increase, I think, is really more is about supply. So I can't tell you what the demand is going to be. That's sort of out there, but we know what the supply is going to be, and that's sort of the same thing with gold and Bitcoin, that we know that's sort of built into the game, that we know with some certainty that the supply is going to increase by a constrained amount. So really, the part of the equation that's left open is the demand side, and do we expect people to have, more or less demand for assets that aren't linked to governments? Do we expect people to have, more or less demand for the ability to, to put a chunk of money away in sort of a safe hidden place that you needed to get to? So, and the other question is, will there be a substitution between gold and Bitcoin for this purpose? And we know the supply part for both of them. It's just, will there be demand to drive that? And I think, anybody who's holding gold just as a hedge against governments should or will likely start to very seriously consider Bitcoin as well.
That's a really good point. I think you're right about that. Okay, so now let's talk a little bit about this. By the way, this was fascinating. I've been wanting to have parts of these conversations for a while because people don't really understand where value comes from. I don't really. I mean, I'm starting to try to get an understanding, and it's clearly relative. It's just, will I give you something for that? At the base, the very base layer. But these are important conversations to have, and I think that the explosion of Bitcoin really has brought that back to the consciousness of the world at the moment. So thank you for that, because it's been incredibly illuminating and really helpful for my understanding of it all.
Well, thank you for giving me the chance to talk about that. I haven't spoken about those topics for a while, but it's near and dear to my heart.
All right, good. So, all right, now let's talk a little bit about what you're doing with Symbiont. Am I saying that right, by the way?
Yeah.
Okay,
so
that's good.
So
Mark would get very upset with me if I named this company the wrong way.
No, Symbiont is I think that the founders might each pronounce it a little bit differently. So however you say it is right. But yeah. So I joined Symbiont very close to after it was founded in 2015, and it was founded essentially to solve problems in capital markets and financial markets using blockchain technology and more specifically. Smart contract technology. So the ability to not only move, I guess, title or tokens representing title to an asset, but also to be able to fully represent the set of rights and obligations associated with that asset. So with that sort of mission in 2015, I should talk a little bit about how the company was started. It was the name Symbiont.
Okay, let's hear it.
Yeah, so the name Symbiont actually represents the symbiotic relationship between traditional capital markets and this sort of emerging crypto space that we're seeing, and that sort of that dynamic is reflected in our founders. So Mark, our CEO and founder, who has
Mark Smith.
Mark Smith, and he's a serial entrepreneur. He's been in financial technology for the last 25 years. He was an early innovator in front office trading technology. He founded one of the first regulated
electronic trading
venues, and he also actually took that same technology and applied it to the foreign exchange market, where I came to meet Mark in the early 2000s, using this retail FX matching platform. So Mark represented the traditional capital market side. The other co-founders, Adam Krellenstein and Evan Wagner, were really deep in the crypto space. They had founded this open source project called Counterparty, which was the first Bitcoin 2.0 project, which essentially looked to add additional functionality to the Bitcoin blockchain. So the first, platform that allowed people to issue tokens that represented other assets was essentially Counterparty, which is this Bitcoin 2.0 protocol that was built on the Bitcoin blockchain. And
Bitcoin 2.0. Tell me what that means, a Bitcoin 2.0 protocol.
So Bitcoin, the use case of Bitcoin, we're all pretty familiar with it. It's a sort of digital cash that can be sent across this distributed database using that protocol. Now, this distributed database could be used for other things as well. So there's a scripting language built into Bitcoin. It's pretty rudimentary, but you're able to do certain functions in it. And essentially what the Counterparty team did was say, we're going to use this database to put our own data on this, our own data, and essentially register assets. So the first, predecessors to the ICO were using the Bitcoin blockchain and not Ethereum, and using this Counterparty protocol. So it allowed you to essentially create arbitrary digital assets that weren't Bitcoin, that could be exchanged on the Bitcoin network. So very similar to ERC tokens on Ethereum.
You could create digital assets that weren't Bitcoin on the Bitcoin network.
Correct.
Okay, I wasn't aware that you could do that.
Yes, and again, it was I would call it more of a technological innovation rather than something that was adopted and widely used to raise capital. There's a few instances where it was, but it was really it was really just a very innovative way to extend the functionality of the Bitcoin blockchain, and it was also a way to, I guess, combine the traditional capital markets experience with a team that was really sort of deep in the public crypto space that was gaining so much traction. So we had these sort of two pieces. We had the traditional capital markets and the crypto space, and they formed together to create Symbiont. And essentially, we thought the value of this technology to capital markets is to create a shared set of books and records where data and logic can be shared to manage the full life cycle of a financial agreement from origination to termination and everything that happens in between. So
Okay.
so for example, one of our and this could be used for managing the life cycle of any financial agreement, whether it be sort of a bilateral financial agreement like an OTC derivative or a derivative contract between two counterparties. So, for example, one of our early POCs was in the insurance space.
Proof of concept.
Proof of concepts, yeah. So we worked with it's a very simple one, but it's pretty illustrative of how the technology can be used to manage the life cycle of an agreement. But it was a simple what was called a catastrophe swap, where there was an insurer that wanted to pass off some of its risk to a particular weather event to a reinsurer. And essentially what we did was create a platform where the insurer can propose terms to the reinsurer. The reinsurer could accept those terms. Those terms can be reflected in boilerplate legal language in what's an ISDA agreement, essentially
That's a derivatives agreement.
The derivatives agreement, exactly. So
I didn't realize that ISDA agreements were used to swap out or to trade, and well, it's really to purchase or sell insurance risks. I always thought it was just financial derivatives. I didn't realize it went to insurance derivatives too.
So yes, and there's a I would say a limited section of insurance derivatives, but this particular one is covered by this cat swap. So there's
Gotcha.
these two guys or two parties, the insurer and the reinsurer, have this agreement, and then there's a third party called Veririsk, which is this industry data provider that is known to be the authority on reporting weather losses, and all these derivative agreements are essentially based on the results of this data provider.
Okay.
So we had these three independent organizations. They didn't necessarily know each other or trust one another, but they're using this shared infrastructure to manage this agreement over time. And then as time would pass, the data provider would publish information about what happened with the weather. Oh, this hurricane hit Florida and cost $10 billion in damages. This hurricane hit Indiana. Indiana wasn't covered by the agreement, so it doesn't matter. But essentially, every input into that agreement would be published to the blockchain as well. So,
Gotcha.
So essentially, what you have is on the same unified ledger, you have the logic of the agreement and all of the inputs into that agreement over time, and then
So you have everything there.
exactly.
Literally, so it's you don't have to. It's the central repository, right?
Well, it's decentralized, but correct. So for any financial
Did I say the I meant decentral
yes,
repository?
Exactly. exactly. So, but essentially, what you're getting here is what you described, and this is a very simple three-party agreement, but this can be extended to entire marketplaces. But what you're getting on this single blockchain is a perfect audit trail of all the interactions of those counterparties throughout the life of the agreement, and all the inputs into that agreement. And these are all digitally signed, so the source of those inputs are also known. So
How long has Symbiont been doing that for?
So we've been doing it for 3.5 years. So we built this platform initially to be able to do what I described,
Right.
which was very, I think, useful for illustrating the technology for proofs of concept.
Mm-hmm.
But I would say it's only in the last year or so that we've developed the privacy capabilities to be able to do what I just described in a way that protects everybody's information.
What do you mean?
So what I described is essentially every step, every input in a financial agreement, from the proposal to the acceptance to
Between three different parties.
to three different parties, is
Right.
all published to a shared decentralized append-only database, which is the blockchain, or in our system we call it the distributed log. Now, all of this information is in our current production systems are encrypted. So while everybody is agreeing that we have the same information, only those who are party to the transaction have the keys necessary to decrypt and execute those transactions.
Right. Okay.
So what I described before with those three parties, they could be on a much broader insurance network with 50 different insurers and reinsurers and banking parties that would need to be on this network.
So up until last year, essentially, everybody would be able to see who was doing what. But with the new capabilities, which is as of about a year ago now, it's essentially pseudonymous?
More than pseudonymous. It's
Or is it permissioned? You can only see it if you're a part of that transaction.
You can only see it if you're a part of that transaction.
And that's the next level for blockchain development, right? Because all of the permissioned accesses, all of the permission access blockchains are going to need to have that feature if they're going to be used by a whole mass of people, correct?
Exactly. And I think the and the way Symbiont is really differentiated from the other blockchain platforms that are trying to service the same space,
Right.
is that we're able to manage privacy in a decentralized fashion. So there's no special party on the network that needs to be in charge of privacy. So in some of the other protocols, there's special nodes, there's orderers and endorsers and operators and all sorts of sort of special roles in the network that are designed to or require that there be a central trusted counterparty for these use cases to exist. But when you remove that restriction, you open the door to a much broader range of use cases, and participants are much more willing to participate when they know that their competitor is not going to be owning the network.
Right.
And that's really been a huge driver of interest in our platform. So we compete directly with much, I guess, more well-known platforms like Hyperledger and Corda's R3 or R3's Corda. However, we tend to attract some really impressive clients who understand that this differentiated capability is really the critical piece that allows us to both have these complex multi-party financial agreements that are managed in a way that doesn't reveal their private information to anybody else on the network, and doesn't require you to trust a central counterparty in order to make the network work. So there's a number of use cases out in sort of the financial services industry that could very much benefit from having this sort of shared source of truth, the shared source of books and records that doesn't sort of give up the privacy.
Strikes me bonds, commercial mortgage-backed securities, residential mortgage-backed securities, perfect fit, right?
they're both great fits they're both great fits. So let's start with bonds because it's a little bit simpler. But the process of registering the bond, defining the basic characteristics, the maturity, the coupon, the banking instructions of the issuer, all the details related to that bond and how it's going to perform over its life are represented as code and are deployed on the smart contract platform. This same bond could then be distributed in a primary issuance to investors who are interested in investing in this bond. Then it's really actually not the end investor that's holding it, but it's the trustee of that investor that's holding it, or custodian.
All right. The trustee is essentially the entity that holds the bonds and can also hold the property, and then you've got administrators that administer it.
Transfer agents, custodians, DTCC. Essentially, all these parties are involved to really manage a fairly basic process where there's a company that needs to raise capital and they want to get a lump sum of capital in return for an obligation to make interest payments and return that capital at the end. When you enter into that agreement on a sort of robust smart contract platform or blockchain network with a robust smart contract platform, you're able to essentially share the logic associated with that agreement. So I will be paying you an interest payment every quarter. You're also able to manage the life cycle of events and record those life cycle events, whether it be issue payment instruction to I use coupon payment already, but essentially the distribution, the secondary trading, the ability to take this asset and trade it elsewhere. It involves all these parties that we discussed. So there's the issuer, there's the investor,
there's accountants, there's lawyers,
and typically
there's the master servicer, the special servicer, depending on whether it's a mortgage-backed security or a regular bond. There's like a ton of different participants. There's borrowers that have to make the payments if it's a mortgage-backed security. So yeah, all of that gets right onto the blockchain. And if you have permissioned access, then certain levels of participants can get certain levels of information, right?
That is a very very well put. So essentially, everybody has access to all of the information encrypted. But if you're party to the transaction, you get to decrypt the business logic and the inputs to determine the state of that asset at any given point in time. So we're working off that single source of truth. However, we're still able to again maintain privacy and confidentiality that's required in capital markets.
That sounds really awesome. All right, so what do you guys have next in store? Can you tell us?
Trying to think of what I'm allowed to tell. So, well, I think so. I think I can say that we are building an institutional network to support the registration and issuance of fixed income securities, but also the same platform will be used to manage other assets as well. So these assets could be OTC derivatives. So, for example, if you're entering into a bond trade, you might have the need to hedge out your interest rate risk. Why not use the same platform since essentially it's a place where agreements can be shared and logic can be shared to describe how you're going to exchange your your interest rate risk. So perhaps enter into a fixed for floating swap with a counterparty, agree to have a third-party data provider, let's say Bloomberg, publish the reference rate every quarter, and then all of a sudden you're able to convert your fixed payment that you're receiving every month into a floating payment, and all the history of the agreement, all the history of the inputs, in this case the reference interest rate, all the records of the payments are all there on this shared perfect audit trail that gets created throughout the life cycle of the agreement.
Sounds really cool. All right, so now we're going to wind up with two questions.
Sure.
All right, the first question is the biggest business lesson that you can share with everyone. Let's hear that. What is it?
I really think it's surrounding yourself with great people. So I was involved in two successful technology startups so far. So the first was this company called Riskmetrics, which was a spin out of JP Morgan that did risk analytics, and now at Symbiont, we've had a great amount of success, growing from I think it was 5 people when I started in 2015 to I think we're up to 70 now. So
oh wow!
So we've grown rapidly. We've been able to partner with some really great clients who've been able to not only provide us with subject matter expertise, but we're influential enough that they're able to bring other partners to the table to help build these ecosystems that are required to get this technology off the ground. So just having a better mousetrap isn't enough. You need a strategy to build this ecosystem. So
right.
At Symbiont, we've been really fortunate to get some what I call lighthouse partners, or essentially very influential partners in the industry who've been able to bring participants to the table. So just to give you an example, in the area of private equity, we just got we just closed our B round, and it was led by NASDAQ Ventures. They're very big in private assets and private equity space, and they've been a fantastic partner in addition to providing capital. Another sort of publicly disclosed relationship, which has been really incredible for us, has been with Vanguard. Vanguard, as you know, is
the fund company.
The fund company, very massive asset manager. Interesting corporate structure in that they're actually a mutual company. They're not owned by shareholders, or they're owned by their investors. So they're in a somewhat unique position in that I think their competitors feel less threatened by them than without giving names, an equivalently sized asset manager that does not have that structure. So because of who Vanguard is, because of their clout, and because of their vision for making capital markets run more efficiently for the benefit of their investors, they've been able to pull a lot of players to the table to work on a variety of different use cases. So the first one that we did with them was really sort of just to dip our toes in the water, which is index data. So essentially, we created a platform that allowed data providers that provide the indexes that Vanguard is tracking to publish those indexes on a blockchain and publish those updates on a blockchain. So any changes get updated in real time and flow through to the PMs much more quickly and more efficiently than they did in the past. And what this does is it lowers operational costs and also reduces tracking error, which is sort of the way that these index funds are evaluated.
So now we know what the what index data distribution is, right?
Exactly.
Bringing us back to the end. So now let me ask you this. We'll close with this one.
Sure.
And it's one thing that you're grateful for. Can be anything at all. Doesn't have to be business related.
Yeah, that's a good question. You know,
We'll bring some good back into the world.
it's true. Like, honestly, I'm really grateful to have a very supportive wife and family that allowed me to to leave a fairly stable and a stable job at a good company to sort of pursue my dream of taking this sort of nascent technology and helping to transform and sort of simplify and improve the way capital markets function, and really do something that I think I would have had a very nice, comfortable life if I continued along my former path. But now I feel like I really have a chance to be part of something bigger and to make a difference in the world that will last beyond me.
And that is the way you close a show. Louis Stone, thank you for coming over.
Thank you very much for having me. It's been a pleasure.